Budweiser, Bud Light, Modelo, Corona. Some of the biggest names in beer, all owned by the same company, Anheuser-Busch InBev. AB InBev is the world's largest brewer, with 500 brands in over 100 countries. It holds about 40% of global market share and a market cap of $88.6 billion.
Our portfolio continues to evolve as consumer preferences they evolve, and we are leading innovation across most of our markets.
But American consumers have changed their drinking habits, and total consumption of beer has dropped 30% over more than 4 decades. As a result, ABI has shifted its strategy towards premiumization and profit prioritization, focusing on expanding into new beverage categories other than simply just beer. Between 2011 and 2021, ABI and Molson Coors, the two leading brewers in the space, experienced a combined 17% drop in U.S. market share.
Beer industry resilient, gaining share of throat globally. Our performance is very good. 60% of our markets growing volume, not only revenues, but growing volumes, and beer premiumizing.
For the first time in 33 years, ABI decided not to renew its Super Bowl ad rights in alcohol for 2023. And some analysts think the decision may be related to the company's biggest brands, Budweiser and Bud Light's, lagging performance, a telling indication of the company's shifting focus. AB InBev brought in $54.3 billion in revenue in 2021. But with the onset of a craft beer revolution, overall beer volume share declining, and now inflation a looming threat, the company, born from a series of massive billion-dollar acquisitions, has grown enormously from beer to the largest in beverage, and perhaps at the expense of the beer industry and its original heritage. Before it became the behemoth it is today, AB InBev began as Leffe, a beer brand based in Belgium. In 1860, Eberhard Anheuser and Adolphus Busch, both pioneers in the beer world, partnered to form the Anheuser-Busch Brewing Association.
So even in the 1890s already, the company known as Anheuser-Busch was already a very hardball dominant player in what was called the shipping business, trying to ship beyond your own local market. It was located in St. Louis, but he had aspirations to ship beer to everywhere in the world.
The company's aggregated acronym, AB InBev, is itself a mashup of several individual company names, the result of a flurry of acquisitions and mergers in a 160-year span. AB is Anheuser-Busch. InBev stands for Interbrew and Ambev. The latter two merged in 2004 before acquiring Anheuser-Busch in 2008. It grew even larger with its 2016 acquisition of SAB Miller. To date, the company is home to the largest and most recognizable brands in the world. In the US market, which represents 1/8 of the company's business, Budweiser is known as the king of beers, with Bud Light being an equally recognizable successor.
So Bud and Bud Light both have storied roles in the history of American brewing, and they are both still the king killers in the market.
AB InBev built that reputation on the back of its long-standing presence as an American beer that survived even through the Prohibition, and grew its marketing to symbolize American life and culture. The brand even temporarily changed its name in 2016 to America. Budweiser's marketing has been historically aggressive, and AB InBev has poured millions into ad campaigns, largely heralded by its dominance of the Super Bowl. The televised sporting event is the advertising industry's foremost time of year, and the most expensive. Prices for 30-second ad spots average $6.5 million, and Budweiser and Bud Light are some of the biggest spenders. It's estimated the company spent about $50 million for the 2019 season.
Bud Light is still the #1 brand in this country, and most people find that very hard to accept. Even though people talk about it as a dying brand, it's still the largest brand that we have in the U.S. beer industry today, and it's been that way for decades.
In the last several years, however, Budweiser has lost favoritism over the crowd, and ABI is seeing much better growth elsewhere. The beer industry is controlled by 3 companies: ABI, Molson Coors, and Constellation. That means the beer market is dominated by the big guys. Hardly a new narrative in American capitalism, but it does mean tension, especially in the industry's current climate of shrinking consumption, a move to premium plus beers or craft, product output, alongside categorical expansion and alcoholic beverages as a whole.
Now today it's doing what every company in the beverage industry is doing, because you really cannot think of brewing as a separate business anymore. It is simply part of the beverage industry. And so it is picking up beverages and beverage fads just as fast as it can.
Despite an aggressive acquisition strategy, AB InBev's total sales volume of 83.8 million barrels in 2020 is less than what it was 40 years ago. But total sales have increased. In other words, fewer cans, but more expensive cans. So what does this mean? In the last several years, the beer industry has seen its growth slow as early as the 1980s.
We sell about 200 million barrels of beer a year in the United States. And that's been relatively constant even as the US population has grown. And so beer has moved from about 60 share of the US beverage alcohol market to now dropping below 45 share in the last year or so.
As for what it means for ABI, cost-cutting measures and spending redirection have become strategic staples, a reverberation of its prominent leadership. Not many consumers have heard of 3G Capital. It's a Brazilian-American investment firm which owns and operates some of the largest conglomerates and companies in the world, including Burger King and Kraft Heinz, along with some of the world's largest brewers, Brazilian Brahma, Interbrew, and SAB Miller. It was the force behind the Interbrew and Ambev deal that led to AB InBev itself. Carlos Brito was CEO of ABI from 2008 to 2021. 3G Capital is notorious and at times controversial for its aggressive cost-cutting tactics. Zero-based budgeting is a core philosophy, and it's why ABI has prioritized profitability and price per barrel versus volume share.
When InBev came in, their immediate goal was to just simply clean out the fat, of which, again, there was a lot of fat. And naturally, that rankled people who'd been there for years. There were a lot of layoffs, more tension. For the first time, the people of St. Louis felt as if it was not their company anymore.
Certainly beer share loss puts pressure on, everyone in the beer industry. There's only so many shelves, so many trucks. And when you have an infrastructure that is losing to another industry, that's going to cause challenges for everyone, in terms of what retailers or distributors focus on. So, while this may be a good business decision for some of the companies, it puts pressure on the industry as a whole to, find ways to maintain a system that was built when, beer had 60 share and now has a much lower share point than it once did.
Profitability also took priority, partly due to a hefty debt load of $123 billion the company accrued after the SAB Miller deal. Reducing that debt is crucial. The company's strategies have been working, insofar as its interest in profitability is concerned. Its Q3 2022 earnings reflected a 12.1% increase in total revenue from Q3 the year prior, even as it sells beer at higher prices. The shrinkage of beer, albeit slow, continues into 2022 with increased interest in spirits and other categories that are gaining market share. Hiking prices of beer are partly to blame, which has been famously driven by Anheuser-Busch.
You go back 20 or 30 years, and beer costs now, controlling for inflation, about what it did a few decades ago. In contrast, hard liquor has gotten a lot cheaper. So, if we started a point in the mid-90s and look today, hard liquor is about 25% cheaper relative to beer than it was. And that means some percentage of beverage alcohol drinkers are going to shift their consumption based on price.
While ABI's overall revenue and growth have fared well this year, its stock has been steadily declining since 2016, raising concerns from investors about the long term. So ABI's reputation is deep-seated, and global reach spans far and wide. And in an industry that's seen many changes in the last 2 decades, that means constant adaptation. It has also poured a whopping $5 million in lobbying efforts in 2021 alone.
The company has done a remarkable job, I think, of maintaining its stranglehold on beer drinkers in the United States. And I don't mean that there are no choices. There are something like 9,000 breweries in the U.S. They are the dominant players in the convoluted distribution stream that is mandated partly by federal but also by state law. They're kind of the thugs in the room, and they'll never go away. That's just who they are.
In 2017, the company responded with a new segment in its business, Beyond Beer, in order to officially penetrate categories beyond the one it got its start in. When craft beer began rising, ABI acquired Craft Brew Alliance, among others, in 2019, and created a craft business unit. When seltzers grew popular, it launched Bud Light Seltzer and acquired Rita's, Neutral, and Kombucha.
We are here to offer consumers on different occasions something so they can stay with us in our portfolio. That's what we're in business for.
Canned cocktails were the fastest growing spirits category in 2021, with $1.6 billion in revenue. And U.S. sales volume of craft beer increased 7.9% this same year. Even the non-alcoholic category has risen. 0% alcohol by volume beer boasts a market value of $328.6 million, up 19.5% from August 2021. ABI and Molson Coors have lost a combined 17% of market share since 2011, indicating the growing footprint of these other categories.
Beer really used to dominate the youngest legal drinking age categories, so 21 to 34. And we've seen with the millennials and kind of coming up next Gen Z that hasn't really been the case.
ABI's roots are in beer, but time, competition, a fierce cost-cutting strategy, and sweeping industry shifts have driven it to evolve from beer to beverages. And tensions have risen between small independent brewers and big beer brands.
If you're a beer maker in the United States, they're your worst enemy because they completely dominate the very complicated distribution chain for beer.
The most recent marked change for ABI's business is the retraction of its Super Bowl ad rights in alcohol, a foothold of 33 years prior. ABI has not officially stated why, but some analysts believe it's an indication of the company's desire to expand its footprint elsewhere and constantly evaluate higher growth opportunities. While consumers are shifting towards premium brands, ABI has been able to meet those changes. In 2021, it saw growth across multiple premium labels. Michelob Ultra has performed in the double digits, and Stella Artois grew by 7% in Q3 2022.
Trading up is this effort on the part of brewers to get people from lower priced sub-premium beers into higher premium price beers. And it's worked brilliantly.
That all begs the question, what are Anheuser's iconic brands, like Budweiser and Bud Light, meant to become as they lose popularity? Are they to keep their accessible, inexpensive heritage, or is it time to modernize? It's a question ABI has grappled with as early as 2018. Recently, the company has seen better growth for those brands in the international market, where they have curiously taken on a more premium persona than their domestic brethren. Budweiser grew by 8.9% in China, its largest market, in Q3 this year. Altogether, while volumes have slowly declined, industry experts insist ABI and the beer market are not going anywhere anytime soon. Though competition has gotten fiercer, ABI's margins have only gotten larger in the last several years, a powerful indication of its size and influence on the market as a whole.
I do think that people should think about brewing not so much as a separate business, but as a player in a brutal, very competitive, larger beverage business.